The AI stock market has been on an incredible rise. Over the past few years, artificial intelligence has gone from something that once sounded like science fiction to one of the biggest investment stories in the world. Investors have poured enormous amounts of money into companies connected to AI, and that money has helped push AI-related stocks to extraordinary valuations. Companies building the chips, software, and infrastructure behind artificial intelligence have become some of the most watched businesses in the entire market. One of the biggest names in this story is NVIDIA. The company became a symbol of the AI revolution because its powerful computer chips are essential for training and running many advanced AI systems. As demand for AI technology exploded, investor excitement exploded with it. Investors started believing that artificial intelligence could completely transform the economy. And honestly, they may be right. AI is already changing how businesses operate, how people work, and how companies create products. Businesses are using AI to automate repetitive tasks, analyze massive amounts of data, improve customer service, create software, and increase productivity. Workers are using AI tools to write, research, design, code, and complete tasks faster. And companies are investing billions of dollars into the technology because they believe AI could create enormous economic opportunities in the future. That is why so many investors believe the AI revolution could be bigger than the internet revolution. The internet changed the way people communicate, shop, work, and do business. And now AI could potentially change many of those same areas again. Imagine a world where businesses can operate with far more automation. Imagine software that can help employees complete hours of work in minutes. Imagine AI systems that can help doctors analyze information, help scientists discover new medicines, and help companies develop products faster. The potential is enormous. But this is where things start getting complicated. Because when investors become extremely excited about a new technology, stock prices can sometimes rise much faster than the actual businesses behind them. And that creates an important question. Are investors buying companies because they truly understand their long-term value? Or are they buying simply because they believe someone else will pay even more for those stocks in the future? This is one of the biggest questions facing the AI stock market today. The technology itself may be revolutionary. The businesses may have enormous potential. But that does not automatically mean every AI stock is a good investment at any price. History has shown us that even the greatest technologies can create investment bubbles. During the late 1990s, the internet changed the world. But many internet companies became massively overvalued, and when investor enthusiasm finally collapsed, stock prices crashed. The internet survived. The technology continued to grow, but many investors still lost enormous amounts of money. And that brings us to the biggest question. Are AI stocks becoming too expensive? Because the real danger may not be that artificial intelligence fails. The real danger could be that investors become so optimistic about AI that they pay prices that are simply too high. And if that happens, even successful AI companies could see their stock prices fall dramatically. So, are we looking at the beginning of the next great technological revolution? Or are we watching the formation of another massive investment bubble? To understand that, we need to look beyond the excitement and examine what these AI companies are actually worth. Now we need to answer the question that every AI investor should be asking. How much are these AI companies actually worth? Because the price of a stock and the value of a company are not always the same thing. This is one of the most important concepts investors need to understand. A stock price tells you what investors are willing to pay for a piece of a company at a particular moment. But the actual value of that company depends on much more. It depends on how much money the business makes, how quickly its revenue is growing, how much profit it generates, how much cash it produces, and, perhaps most importantly, how much money investors believe it can make in the future. A company can be incredible and still have a stock price that is too expensive. Think about it this way. Imagine you find an amazing business that is growing quickly, has a great product, and has a huge future. You might think, this is a fantastic company. And you could be completely right. But if you pay an enormous price for that company, your investment could still perform badly. That is where valuation becomes extremely important. Investors often look at numbers like earnings, revenue, and cash flow to understand what a company is really worth. These numbers help investors separate the excitement from the actual business performance. But when investors become extremely excited about a new technology, expectations can become enormous. And this is exactly what can happen during periods of rapid technological innovation. Investors start imagining what a company could become 5, 10, or even 20 years from now. They begin pricing in massive future growth. They assume AI will transform entire industries. They assume businesses will spend enormous amounts of money on AI. They assume companies providing AI technology will capture a huge share of that future spending. And some of those assumptions may turn out to be correct. But there is a problem. Investors may start pricing in years of future growth before that growth has actually happened. Imagine a company that is successful today. Now imagine investors suddenly decide that this company could become 10 times larger in the future. The stock price may start rising immediately. But the actual business still has to grow into those expectations. It has to generate more revenue. It has to produce more profits. It has to maintain its competitive advantage. And it has to continue growing for years. That can create a dangerous situation. Because the higher expectations become, the more difficult it becomes for a company to keep surprising investors. When expectations are low, a company only needs to perform reasonably well to make investors happy. But when expectations become extremely high, even a great company can disappoint the market. Imagine an AI company expected to grow at an extraordinary rate. If it grows slightly slower than expected, investors may suddenly become nervous. The stock price could fall even if the company is still growing. And this is one of the biggest risks in highly valued technology stocks. The problem isn't necessarily that the company is bad. The problem is that the price may already assume that everything will go perfectly. And in the real world, things rarely go perfectly. Competition can increase. Technology can change. Profit margins can decline. Companies can spend more money than expected. Government regulations can change. And new technologies can appear. All of these factors can affect the future profits of AI companies. So the big question is not simply whether AI will succeed. The bigger question is whether the success of AI is already fully reflected in today's stock prices. Because if investors have already priced in years of incredible growth, the companies may need to deliver extraordinary results just to justify those valuations. And that is where the AI stock bubble debate.
The technology may be real. The demand may be real. The companies may be successful. But if the price investors are paying becomes too high, the risk can increase dramatically. So, are AI stocks actually in a bubble? Or are investors simply recognizing the enormous potential of the next technological revolution? To answer that question, we need to look at what happened during previous technology bubbles and what could happen if history starts repeating itself.